Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some ratios and understanding the ratio bet. And what that means is that I use ratios to value things. It's an asset versus an asset. And we're going to use uranium as an example. But when you make this bet, it's not a direct bet. So when you're one level, it's an asset versus an asset, and it's the way that these things move against each other over time. There's leverage that is involved as the ratios go deeper. And I'm going to describe kind of how that works. So you've got stocks. This is stocks, and then you've got gold. That is a ratio. Now, gold is just basically a mechanism to account for the money supply. That's all it is. At least that's the way that I view it. And under inflationary periods, gold gets revalued higher and accounts for the monetary base. So what you see over time is you'll see stocks under certain market conditions rapidly go higher and outpace gold, leaving gold in the dust. And when the market conditions change over time, the money flows from stocks back to gold. And that ratio shifts quite dramatically. Now, commodities are a play or add leverage to the move of gold. And it's not a one-to-one leverage. We'll get into that, but they are leveraged at certain periods of time massively to the price of gold. And then the mining companies, since their profit and earnings per share, if you're in a, let's say the ratio is very cheap, it's very undervalued. We are below the cost curves of the mining companies. And what happens is the mining companies get sold off dramatically, like basically pennies on the dollar, literally pennies on the dollar. Now, when you're that cheap to the downside, and all of this rotates back, and I'll show you what that looks like in this presentation of rotating all these ratios backwards, back to overvalued, from an undervalued to an overvalued state. The purchasing power gains that can be created are ludicrous. And I'm going to show you exactly how this all plays out. So I'm going to use uranium as an example because I know we have a lot of uranium guys on the channel, and I also think it's one of the best opportunities. So here we go. This is understanding the ratio bet in uranium. So understanding the bet. And again, this is ratios, which is relative value. It's an asset versus an asset. So I'm going to start with the Dow to gold ratio. Right now, it's at 19.5. That ratio is incredibly expensive compared to history. A ratio low of the Dow to gold ratio is somewhere between 6 and 1. So the first level of the ratios, basically the Dow to gold ratio, and we're pricing everything against stocks. I'm using the Dow as stocks, and gold is our barometer of how much money's in the system. So gold could outperform the Dow by a factor of 3 to 19.5. I'm just going to say on average, let's just say it's a 10x. So that gold's under this inflationary period that's going to come, my guess is it's going to outperform the Dow or stocks by about 10x on average. And in my opinion, interest rates are the trigger of the movement of money from stocks into commodities or precious metals. That is our trigger. When interest rates go up and they hit certain levels, which spark a rotation of money between assets and sectors. And it's going to take some time. This doesn't happen overnight. Now here's the Dow to gold ratio. We're at 19.5. You can see that we're kind of coming up. We could break up or down here. I'm not going to guess which one, but eventually what I am proposing is that we're going to see a decline in the ratio over time. It bottomed at 6 last time, and we've come back up, and we were in 2018, I think we were going to go into a commodity bull market, but they delayed this. COVID did. And they brought it back up because they could lower interest rates and print a bunch of money, and it all funneled into stocks and bonds. what I'm proposing is if interest rates go up, this money's going to rotate out, and you're going to see this ratio drop. And it's going to go somewhere between 6 and 1, is my guess. So that's the first level of the ratio. Now, interest rates, just to look at that, because that's that sparks the rotation of money. Back in 2015, if you look here, we were coming up and interest rates were going to go up higher in 2018. 2018, it was about to break and move. That is 2018 is when the ratio started to decline and you were seeing a rotation of money. And then this was the COVID sell-off. This is another reason why I kind of think it was almost a planned pandemic. But the rotation was starting to happen already, and then all of a sudden rates dropped all the way down to hold all this market up, I think. But we're back on the channel. I'm expecting this to go up rates over time. And this was a 40-year bear market from 1980, early 80s, 81, all the way down to, I think, 2021, about a 40-year bear market in yields. And when this goes up, it's going to spur the rotation of money out of bonds and stocks into precious metals and commodities. Here's the gold to monetary base ratio. The last time we had a interest rate bull market like this, look what gold did when interest rates went up. And again, I also want this to make this crystal clear. Rates were going up. This was the largest bull market in real estate, with interest rates going up, mortgage rates going up. Another one I wanted to touch on there. This increasing in interest rates shot gold higher, and gold revalued itself to the monetary base. I am proposing with this descending wedge pattern that we could potentially do this again at some point here in the near future, where this ratio, which has never been this low in history, the gold to monetary base ratio has never been this out of whack, could revert back and maybe even overshoot. Maybe we go to 5 or 5.5. I don't know. But it looks like average is about 3.5 on the gold standard. They were obviously cheating the system back in this time frame, and then gold recounted for it when it was freely traded. So I'm expecting this to move up. How much? Anyone's guess. But it's probably going to be revalued quite dramatically. Now, getting into uranium. This is the second level of the ratio. This is the uranium to gold ratio. And notice that we are now we're 2 steps away from stocks. A stock to gold ratio and a gold to uranium ratio. This ratio was at 60. And right now it is still cheaper than it's ever been in relationship to gold. And one thing I want to point out is if gold is this cheap to the monetary base, and this is going to rocket higher, and uranium's this cheap and never been this cheap in relationship to gold, what do you think this is going to look like when this reverses back all the way down to maybe a 1-to-5 ratio, which is these bottoms in here? That's going to be a massive revaluation. I mean, absolute massive revaluation of uranium. And looking at this current ratio, it's at 54. It's $33.75 per pound, $18.27 per ounce. Do the math, it's 54 pounds per ounce. And what I'm proposing is that this 54 here comes all the way back down to a market top of about 5. So I think 54 pounds an ounce will go to 5 pounds an ounce at some point in the future. It could even go lower than this. So the leverage to uranium, this is the mining companies. So this here is the leverage of the uranium ratio, and this is 12. This is about a 12x. Now the leverage to uranium in the mining companies is about a 3 to 5x for the small caps and a 2 to 3x for the large caps. Somewhere in here, this leverage is what the mining companies provide to uranium. So now you're at a third. You're at a third level, not a second level, but a third level. And what this looks like, and what the bet is we've got uranium. That's what we're talking about. We have overvalued on the left-hand side, undervalued on the right-hand side. We've got Dow or stocks, which all of the money went this way into the Dow. It went from uranium mining companies and uranium and gold and transferred all the way to stocks. And that's where all the money's at. We know that by the ratios. The ratios are incredibly cheap. It's cheap here. It's cheap here. That's gold. And it's cheap against stocks. Gold is. So the money's in stocks and it's not in gold or uranium. And definitely not in uranium mining companies. What I'm proposing is that when the market conditions change, when interest rates change and these things start to move, all of this money is going to basically revert back and go and chase these uranium mining companies and uranium and gold. So you're going to see this go backwards. You're going to go from an overvalued state of Dow and an undervalued state of uranium mining companies. Markets condition change, and we've got some time that passes, and eventually uranium mining companies will be overvalued, and the Dow will be cheap. This is a rotation of money flowing from stocks into gold, into uranium, and into uranium mining companies, creating this different valuation outlook. And we are at such undervalued spots for uranium that I consider this to be a once-in-a-lifetime opportunity. And what's given here is, let's just say gold outperforms the Dow by a 10x. That is this relationship here. Then uranium outperforms gold by a 12x. That's this relationship here. And then uranium mining companies outperform by average of 3x. That's this relationship here. So the total could be 3.5 times 12 times 3 times. So the potential could be 126 times the performance of the Dow. What that means is that every dollar that you put in a uranium mining company and you were to get the average return of a 3x against uranium, and then the 12x of uranium times gold, and then a 3.5x of gold versus the Dow, that each dollar in the uranium mining company would return $126 of the Dow when these things all reverse ratios. So that is the total leverage and price purchasing power performance of uranium mining companies versus the Dow. Now, this is a pretty profound statement that I'm putting up here. Now, I'm not talking about, that's not going to be 126 times your up move in necessarily in the price itself in dollar terms. This is in Dow terms, in purchasing power against the Dow. The Dow could remain flat, the Dow could go down while uranium goes up to get that 126x. Now, there's other opportunities. It's just not uranium. There are other fantastic opportunities in other areas. And that's one of the reasons why I would subscribe to the channel, to find out what those other areas are. There's solar, there's oil and natural gas, there's copper, there's platinum, there's silver. There's a whole bunch of different ones that provide very large leverage to moves that I think could potentially be coming. Now, speaking of uranium, and I obviously have 126x here, I don't even think that's aggressive. An aggressive number, if I were to really do an aggressive number, I think that's a conservative number. Now, let's say we go to a 1-to-3 ratio from 60 of where we were at. And so I'm going to use an aggressive ratio on gold too. So let's say the gold to Dow ratio, this happens when gold, let's say gold rockets. Let's say it's an 8,000. So let's say it's an 8, let's say it's like a 5x. All right, so 5. And then let's say we go from a 3x. So 60 divided by 3 is a 20. Let's do 20 times 8 times, and we're in a small mining company that finds something like an exploration company. We're going to use a value of 6. That's 960. Which means that $1 put in one of these, and guys, I don't know which one it is. This one's like the Hail Mary pass, and somebody finds a big deposit during a uranium boom. But there's potential of an exploration company returning 960 times your money. Or I should say, you have your uranium shares in that company, and it returns a price purchasing power performance gain of 960 times the Dow, which means $1 can buy $960 worth of the Dow. And I don't know of leverage of any other asset in the world that can provide that type of leverage. And this could do it very quickly. But I can't tell you what company it is. I don't know which one's going to have a big find. But the potential's there, and it could even be bigger than that. There are other potential areas as well that could perform quite dramatically in terms of purchasing power gains. I think another area is natural gas. I've said this before on the channel. If you guys have been on this channel for a while, you know I'm a big natural gas bull. And I also like oil. So all of these, uranium, natural gas, and oil, copper. I don't know if copper could be a big one too, but I don't know if it's going to have as much leverage as some of these. And the way that the chart's looking on uranium right now, it's looking very good. I think we're getting closer to a big move. So hopefully this allows everyone a better understanding of what the bet we're making and how all the ratios align. And when they go from an undervalued state over here and swap all the way to an overvalued state, how powerful that is in terms of purchasing power gains. And this is stuff that I came up by myself. I didn't read this in a book, so there's no way to, I guess, figure this out unless I write the book myself. But hopefully you guys like this content. Give me a thumbs up. Subscribe to the channel if you haven't already subscribed. And thank you for listening. This is Finding Value.